Question 1. Market research demonstrates that several insurance firms are considering the implementation of new, advanced insurance software systems to enhance operational efficiency and customer experience. As a certified insurance supervisor, CIS, overseeing these firms, which of the following approaches to evaluating these new systems best aligns with UK regulatory requirements and professional ethical standards? Option A. Prioritize the selection of the software system that offers the most significant cost savings, assuming the vendor's assurances regarding security and compliance are sufficient. Option B. Delegate the entire risk assessment and validation process to the software vendor, relying on their internal controls and certifications. Option C. Expedite the implementation process by focusing on rapid deployment, with post-implementation testing and validation to address any issues that arise. Option D. Conduct a thorough risk assessment that identifies potential threats to data security, system resilience, and regulatory compliance, and ensures mitigation strategies are in place before full implementation. The correct answer is D. Conduct a thorough risk assessment that identifies potential threats to data security, system resilience, and regulatory compliance, and ensures mitigation strategies are in place before full implementation. Explanation: this scenario is professionally challenging because the certified insurance supervisor, CIS, must balance the operational efficiency gains promised by new insurance software systems with the paramount regulatory obligations to protect policyholders and maintain market integrity. The supervisor's judgment is critical in ensuring that technological advancements do not inadvertently create new risks or exacerbate existing ones, particularly concerning data security, system resilience, and compliance with all applicable UK insurance regulations. The correct approach involves a comprehensive risk assessment that systematically identifies, analyzes, and evaluates potential threats and vulnerabilities associated with the implementation of new insurance software systems. This approach aligns with the Financial Conduct Authority's FCA principles, specifically Principle 3, Customers' Interests, and Principle 7, Communications with Clients, by ensuring that systems are robust, secure, and do not compromise the fair treatment of customers or the integrity of regulatory reporting. It also reflects the broader prudential requirements for insurers to maintain adequate systems and controls, as outlined in the Prudential Regulation Authority's PRA rulebook, which mandates effective risk management frameworks. An incorrect approach that focuses solely on cost reduction without adequate consideration of security and compliance would fail to meet regulatory expectations. This would represent a breach of the duty to act with due skill, care, and diligence, potentially exposing policyholders to data breaches or service disruptions, and the firm to regulatory sanctions. Another incorrect approach that prioritizes rapid deployment over thorough testing and validation would similarly be professionally unacceptable. This overlooks the critical need for system reliability and accuracy, which are essential for accurate policy administration, claims processing, and regulatory reporting. Failure to ensure system integrity can lead to mispricing, incorrect policy terms, or inaccurate financial statements, all of which contravene regulatory requirements and ethical standards. A further incorrect approach that delegates the entire risk assessment process to the software vendor without independent oversight would also be flawed. While vendor expertise is valuable, the ultimate responsibility for ensuring regulatory compliance and managing risks rests with the insurance firm and its supervisors. Relying solely on vendor assurances without independent verification would be a dereliction of duty and a failure to exercise professional skepticism. The professional decision-making process for similar situations should involve a structured risk management framework. This includes defining the scope of the assessment, identifying all relevant risks, operational, financial, regulatory, reputational, evaluating the likelihood and impact of each risk, and developing appropriate mitigation strategies. Supervisors should engage with IT and compliance departments, review vendor documentation critically, and ensure that testing protocols are robust and aligned with regulatory expectations. Continuous monitoring and periodic reassessment of risks are also crucial to adapt to evolving threats and regulatory landscapes. Question 2. Operational review demonstrates that a significant increase in the volume and nature of a specific type of risk is anticipated due to a new product launch. The existing reinsurance treaty, which covers a broad range of risks, was negotiated based on the insurer's historical risk profile. The supervisor is aware that this new product will materially alter the risk exposure covered by the treaty. What is the most appropriate course of action for the supervisor to ensure compliance with regulatory requirements and ethical obligations regarding reinsurance? Option A. Proceed with the new product launch and address any potential impact on the reinsurance coverage only if a claim arises. Option B. Immediately inform the reinsurer of the anticipated change in risk profile and seek to amend the existing treaty or arrange separate reinsurance for the new business. Option C. Absorb the increased risk internally without any notification to the reinsurer, assuming the existing treaty has sufficient capacity. Option D. Inform the reinsurer of the change in risk profile, but unilaterally adjust the premium paid under the existing treaty to reflect the increased exposure. Correct answer is B. Immediately inform the reinsurer of the anticipated change in risk profile and seek to amend the existing treaty or arrange separate reinsurance for the new business. Explanation: this scenario presents a professional challenge because it involves a potential conflict between the immediate financial interests of the ceding insurer and the long-term integrity of its reinsurance arrangements, as well as potential regulatory breaches. The supervisor must exercise careful judgment to ensure compliance with regulatory requirements and ethical standards. The correct approach involves transparently disclosing the material change in risk to the reinsurer and seeking their agreement to amend the reinsurance contract or to reinsure the new risk separately. This upholds the principle of utmost good faith, which is fundamental to reinsurance contracts. Regulators, such as those overseeing the UK insurance market, expect insurers to act with transparency and integrity in their dealings with reinsurers. Failure to disclose material changes that affect the reinsured risk can be considered a breach of contract and potentially a breach of regulatory conduct rules, as it misrepresents the risk profile upon which the original reinsurance agreement was based. This transparency ensures the reinsurer can accurately assess its exposure and adjust premiums or terms accordingly, maintaining the financial soundness of both parties. An incorrect approach would be to proceed with the new business without informing the reinsurer. This is ethically unsound, as it violates the principle of utmost good faith and is likely a breach of the reinsurance contract's terms and conditions, which typically require disclosure of material changes. From a regulatory perspective, this constitutes misrepresentation and could lead to penalties, including fines and reputational damage, as it undermines the supervisory objective of ensuring the financial stability and fair conduct of insurance firms. Another incorrect approach would be to attempt to retroactively adjust the existing reinsurance contract without the reinsurer's explicit consent. This is a breach of contract and demonstrates a lack of respect for the agreed-upon terms. It also suggests an attempt to manipulate the reinsurance arrangement to the detriment of the reinsurer, which is ethically unacceptable and could be viewed by regulators as an attempt to circumvent proper risk management and capital adequacy requirements. A further incorrect approach would be to simply absorb the new risk internally without any adjustment to the reinsurance program. While this might seem financially expedient in the short term, it fundamentally alters the risk profile that the existing reinsurance was intended to cover. If the new business significantly increases the insurer's exposure, this could jeopardize its solvency and ability to meet its obligations to policyholders, thereby failing to meet regulatory expectations for prudent risk management and capital adequacy. The professional decision-making process for similar situations should involve a thorough understanding of the reinsurance contract's terms and conditions, particularly clauses related to disclosure and material changes. It requires an assessment of the materiality of the change in risk and a proactive engagement with the reinsurer. If there is any doubt about the materiality or the required disclosure, seeking legal and actuarial advice is prudent. The ultimate goal is to maintain the integrity of the reinsurance relationship and ensure compliance with all applicable regulatory frameworks, prioritizing transparency and good faith. Question 3. The risk matrix shows a moderate likelihood and high impact rating for a potential breach of data privacy regulations concerning customer policy information. As a certified insurance supervisor, what is the most appropriate initial step to take? Option A. Initiate a formal internal investigation to gather facts and assess the extent of the potential breach. Option B. Immediately report the potential breach to the relevant regulatory authority. Option C. Take no immediate action, as the risk is only moderate and the impact is not yet confirmed. Option D. Implement immediate disciplinary action against staff members suspected of mishandling data. The correct answer is A. Initiate a formal internal investigation to gather facts and assess the extent of the potential breach. Explanation. Scenario analysis. This scenario presents a professional challenge for a certified insurance supervisor, CIS, by requiring them to navigate a situation where a potential regulatory breach has been identified. The challenge lies in balancing the need for prompt action to protect policyholders and maintain market integrity with the requirement for a thorough and fair investigation. A CIS must exercise sound judgment to determine the most appropriate course of action, considering the severity of the potential breach, the available evidence, and the relevant regulatory framework. The pressure to act quickly must be tempered by the need to avoid premature conclusions or actions that could unfairly prejudice the firm or individuals involved. Correct approach analysis. The correct approach involves initiating a formal internal investigation. This is the most appropriate professional response because it directly addresses the identified risk by seeking to gather facts and evidence in a structured manner. This aligns with regulatory expectations that firms have robust internal controls and processes for identifying and addressing potential compliance issues. A formal investigation allows for a systematic review of the relevant policies, procedures, and transactions, ensuring that all aspects of the potential breach are examined. This methodical approach is crucial for determining the actual extent of any noncompliance and for identifying root causes, which is essential for implementing effective remedial actions and preventing future occurrences. This aligns with the overarching regulatory objective of ensuring fair treatment of policyholders and the financial soundness of insurers. Incorrect approaches analysis. Ignoring the identified risk is a significant regulatory and ethical failure. It demonstrates a disregard for the firm's compliance obligations and a failure to protect policyholder interests. This inaction could lead to ongoing breaches, potentially causing substantial harm to consumers and reputational damage to the firm. It directly contravenes the duty of a CIS to act with due diligence and to uphold regulatory standards. Immediately reporting the potential breach to the regulator without conducting an initial internal assessment is also an incorrect approach. While transparency with the regulator is important, a premature report without proper internal due diligence can be inefficient and may lead to unnecessary regulatory scrutiny or intervention. It bypasses the firm's responsibility to investigate and attempt to resolve issues internally first, which is often an expected part of the regulatory process. This approach can also be seen as an abdication of the supervisor's responsibility to manage risks within the organization. Implementing immediate disciplinary action against staff without a thorough investigation is another incorrect approach. This demonstrates a failure to follow due process and can lead to unfair outcomes for employees. It also bypasses the critical step of understanding the root cause of the potential breach, which may not be solely attributable to individual misconduct, but could stem from systemic issues, inadequate training, or flawed processes. Such an action could also have legal repercussions and undermine employee morale and trust. Professional reasoning. Professionals in a CIS role should employ a structured decision-making framework when faced with potential regulatory breaches. This framework typically involves 1. Risk identification and assessment, recognizing and evaluating the potential impact and likelihood of the identified risk. 2. Information gathering, collecting relevant data and evidence. 3. Internal investigation, conducting a thorough and impartial review of the situation. 4. Regulatory consultation if necessary, determining when and how to engage with the regulator. 5. Remediation and control implementation, developing and executing plans to address the breach and prevent recurrence. 6. Documentation and reporting, maintaining clear records of all actions taken and reporting as required. This systematic approach ensures that decisions are evidence-based, compliant with regulations, and ethically sound, prioritizing the protection of policyholders and the integrity of the insurance market. Question 4. Cost-benefit analysis shows that while managing individual claims is resource-intensive, an insurer's primary concern regarding widespread economic downturns and the potential for large-scale natural disasters should be addressed through robust capital reserves and reinsurance strategies. Considering the regulatory framework for insurance supervisors, Which classification of risk best aligns with the need for such prudential measures? Option A, particular risk. Option B, fundamental risk. Option C, speculative risk. Option D, operational risk. The correct answer is B, fundamental risk. Explanation: this scenario is professionally challenging because a certified insurance supervisor, CIS, must discern the fundamental nature of risks to ensure appropriate regulatory oversight and capital adequacy, rather than focusing on the superficial or speculative aspects. Misclassifying risk can lead to inadequate reserves, improper pricing, and ultimately financial instability for insurers, which directly impacts policyholders and the broader financial system. The CIS's role is to uphold regulatory integrity and solvency. The correct approach involves identifying that the insurer's exposure to widespread economic downturns and natural disasters represents fundamental risk. This is because these events have the potential to affect a large number of policyholders or a significant portion of the market simultaneously, and their occurrence is largely outside the control of individual policyholders or the insurer's direct underwriting practices. Regulatory frameworks, such as those overseen by the FCA in the UK, assuming this is the relevant jurisdiction for CIS, mandate that insurers hold sufficient capital to cover such systemic risks. The CIS must ensure the insurer's risk management framework and capital allocation are aligned with the potential impact of these fundamental risks, as per prudential requirements designed to protect policyholder interests and market stability. An incorrect approach would be to classify the insurer's exposure to widespread economic downturns and natural disasters as purely speculative risk. Speculative risk, by definition, involves the possibility of gain as well as loss, and is typically associated with business ventures or investment decisions. While an insurer's investment portfolio might contain speculative elements, the core underwriting risks of widespread economic downturns and natural disasters are not speculative in nature. They are inherent to the insurance business and are characterized by potential for loss only. Focusing on speculative risk would lead to an underestimation of the insurer's true exposure and a failure to comply with capital requirements designed for fundamental risks. Another incorrect approach would be to focus solely on particular risk. Particular risks are those that affect only individuals or a small group of individuals and are generally insurable through standard underwriting practices. Examples include a single house fire or a specific car accident. While an insurer manages particular risks daily, the question highlights systemic events that transcend individual policy impacts. Overemphasizing particular risk management while neglecting fundamental risk would mean the insurer is not adequately prepared for catastrophic events that could threaten its solvency, violating regulatory expectations for comprehensive risk management. The professional decision-making process for similar situations requires a systematic evaluation of the nature and scope of the risk. CIS should first consider whether the risk is insurable and whether it has the potential for catastrophic loss. Then, they must differentiate between risks that are largely controllable or individual-specific particular, and those that are systemic and broadly impactful fundamental. Finally, the distinction between pure risk, loss only, and speculative risk, gain or loss, is crucial for determining the appropriate regulatory treatment, capital requirements, and risk mitigation strategies. This structured analysis ensures compliance with regulatory mandates and upholds the principles of sound financial management within the insurance sector. Question 5. The evaluation methodology shows a potential discrepancy in the disclosure of policy terms during the sale of a life insurance policy, leading to a client complaint. As a certified insurance supervisor, what is the most appropriate immediate action to take? Option A. Initiate an immediate review of the policy contract, the client's specific circumstances, and the sales advisor's conduct to determine if a regulatory breach or misrepresentation has occurred. Option B. Advise the client that their concerns are likely unfounded and close the complaint without further investigation. Option C. Proceed with rescinding the insurance contract immediately based on the client's assertion of non-disclosure. Option D. Focus solely on issuing a formal warning to the sales advisor for potential procedural error. Correct answer is A. Initiate an immediate review of the policy contract, the client's specific circumstances, and the sales advisor's conduct to determine if a regulatory breach or misrepresentation has occurred. Explanation: this scenario presents a professional challenge because a supervisor must balance the need to ensure compliance with regulatory requirements regarding insurance contract disclosures with the practical realities of managing a team and the potential for human error. The supervisor's judgment is critical in determining the appropriate level of intervention and corrective action without unduly penalizing staff or compromising the integrity of the sales process. The correct approach involves a thorough review of the specific contract, the client's circumstances, and the advisor's actions to ascertain if a material misrepresentation or omission occurred that would render the contract voidable or otherwise breach regulatory obligations. This approach is justified by the principles of fair dealing and consumer protection enshrined in insurance regulations, which mandate that clients receive accurate and complete information to make informed decisions. Specifically, regulations typically require insurers to ensure that all terms, conditions, and exclusions are clearly communicated, and that no misleading statements are made. A supervisor's duty includes upholding these standards by investigating potential breaches and taking appropriate remedial steps, which may include contract rescission, policy adjustment, or disciplinary action against the advisor, depending on the severity and intent. An incorrect approach that involves immediately assuming the contract is invalid and initiating rescission without a proper investigation fails to adhere to due process and may unfairly disadvantage the client or the insurer. This bypasses the established procedures for handling contract disputes or errors and could lead to legal challenges. Another incorrect approach, which is to dismiss the client's concerns without a thorough review, directly contravenes the regulatory duty to investigate customer complaints and ensure fair treatment. This demonstrates a lack of diligence and a failure to uphold the supervisor's responsibility to oversee the ethical conduct of their team and protect client interests. A further incorrect approach, which is to solely focus on disciplining the advisor without addressing the contract's validity or the client's situation, neglects the primary regulatory objective of ensuring the contract is appropriate and compliant. While advisor conduct is important, the immediate priority is the integrity of the insurance contract and the protection of the policyholder. The professional decision-making process in such situations should involve a systematic approach. First, gathering all relevant facts and documentation. Second, assessing the situation against applicable regulatory requirements and company policies. Third, consulting with legal or compliance departments if necessary. And fourth, determining and implementing the most appropriate course of action that prioritizes regulatory compliance, consumer protection, and fairness to all parties involved. Question 6. The monitoring system demonstrates that a previously high-performing team member is now consistently missing deadlines and producing work below acceptable quality standards. As their supervisor, you need to address this situation effectively and ethically, ensuring compliance with internal policies and relevant regulatory guidelines for employee management. Which leadership style would be most appropriate to initiate the conversation and subsequent action plan? Option A, laissez-faire leadership. Option B, servant leadership. Option C, transactional leadership. Option D, transformational leadership. The correct answer is D, transformational leadership. Explanation. This scenario is professionally challenging because it requires a supervisor to balance the immediate need for compliance and efficiency with the long-term impact on team morale and development. A supervisor must not only identify performance issues, but also address them in a manner that aligns with regulatory expectations for fair treatment and professional conduct, while also fostering a positive and productive work environment. Careful judgment is required to select a leadership style that achieves these competing objectives effectively. The correct approach involves a transformational leadership style. This style focuses on inspiring and motivating team members to achieve their full potential, fostering a shared vision, and encouraging innovation. In this context, a transformational leader would engage the underperforming team member in a dialogue about their challenges, understand the root causes of their performance issues, and collaboratively develop solutions. This approach aligns with regulatory expectations for fair performance management, which often implicitly or explicitly requires a supportive and developmental approach rather than purely punitive measures. Ethically, it upholds the principle of treating individuals with respect and investing in their growth. This is crucial for maintaining a motivated and engaged workforce, which indirectly supports the firm's overall compliance and operational integrity. An approach based on transactional leadership would be incorrect. This style focuses on rewards and punishments, setting clear expectations and consequences. While it can be effective for routine tasks, applying it rigidly to performance issues without understanding the underlying causes can lead to demotivation, resentment, and a focus on simply avoiding penalties rather than genuine improvement. This could be seen as a failure to adequately support employee development, potentially contravening guidelines on employee welfare and fair management practices. A servant leadership approach, while generally positive, might be less directly applicable as the primary style in this specific instance, though elements can be integrated. A pure servant leader might prioritize the needs of the team member to the extent that they delay necessary corrective action, potentially impacting overall team performance and compliance. While empathy and support are vital, the supervisor's ultimate responsibility is to ensure the team meets its objectives and adheres to regulations. Overemphasizing the servant aspect without a clear path to performance improvement could lead to a prolonged period of underperformance, which is not in the best interest of the firm or its clients. The professional decision-making process for similar situations should involve a situational leadership framework. This means assessing the team members' competence and commitment, and then adapting the leadership style accordingly. For performance issues, a blend of transformational and directive approaches is often most effective. The supervisor should first seek to understand the situation, diagnostic, then communicate a clear plan directive, and finally provide support and encouragement supportive, while holding the individual accountable for progress. This iterative process ensures that both individual development and organizational objectives are met. Question 7. What factors determine the most effective approach for a certified insurance supervisor to proactively assess and manage risks within customer relationships? Option A. Responding only to customer complaints as they arise to ensure prompt resolution. Option B. Analyzing complaint data, customer feedback trends, and interaction logs to identify systemic issues and potential vulnerabilities. Option C. Focusing exclusively on the performance metrics of individual customer-facing staff. Option D. Prioritizing the speed of resolving customer queries above all other considerations. The correct answer is B. Analyzing complaint data, customer feedback trends, and interaction logs to identify systemic issues and potential vulnerabilities. Explanation. This scenario is professionally challenging because a supervisor must balance the need for efficient customer service with the regulatory obligation to ensure fair treatment and accurate record keeping. The supervisor's decision impacts customer trust, regulatory compliance, and the firm's reputation. Careful judgment is required to identify and mitigate risks associated with customer interactions. The correct approach involves proactively identifying potential risks in customer relationships by analyzing complaint trends, customer feedback, and interaction data. This allows for the development of targeted training and process improvements to address systemic issues before they escalate into significant breaches of regulatory requirements or customer dissatisfaction. This aligns with the principles of treating customers fairly and maintaining robust internal controls, as expected under the regulatory framework governing insurance supervision. It demonstrates a commitment to a proactive risk management culture, which is a cornerstone of responsible supervision. An approach that focuses solely on reactive complaint handling fails to address the root causes of customer dissatisfaction and potential regulatory breaches. This reactive stance can lead to repeated issues, increased regulatory scrutiny, and damage to the firm's reputation. It neglects the supervisory duty to implement preventative measures. An approach that prioritizes speed of resolution over thoroughness risks, overlooking critical details that could indicate systemic problems or regulatory noncompliance. While efficiency is important, it should not come at the expense of accuracy and fairness in customer dealings. This can lead to incorrect advice or inadequate resolution, potentially breaching regulatory obligations. An approach that relies solely on individual staff performance without considering broader systemic factors or training needs misses opportunities for organizational improvement. While individual accountability is important, effective supervision requires identifying and addressing the underlying causes of performance issues, which may stem from inadequate training, unclear processes, or insufficient resources. Professionals should adopt a risk-based approach to customer relationship management. This involves regularly assessing potential risks to customers and the firm arising from customer interactions. Supervisors should use data analytics on customer feedback, complaints, and sales practices to identify emerging trends and potential vulnerabilities. Based on this assessment, they should implement targeted interventions, such as enhanced training, process reviews, or policy updates, to mitigate identified risks and ensure ongoing compliance with regulatory standards and ethical obligations. Question 8. Examination of the data shows a junior underwriter has processed a commercial property insurance renewal, noting a discrepancy between the surveyor's report highlighting significant structural vulnerabilities and the policy wording which appears to exclude coverage for such pre-existing conditions without explicit endorsement. The underwriter has proceeded with the renewal based on their interpretation of standard policy exclusions. As the supervisor, what is the most appropriate course of action to ensure regulatory compliance and sound underwriting practice? Option A. Immediately reject the renewal and instruct the junior underwriter to requote the business with a significantly higher premium to account for the perceived risk. Option B. Conduct a detailed review of the surveyor's report and the policy wording, cross-referencing with the underwriter's notes to ascertain the accuracy of the exclusion and the necessity for an endorsement, and discuss findings with the junior underwriter. Option C. Accept the junior underwriter's interpretation of standard exclusions and approve the renewal, trusting their judgment on routine matters. Option D. Focus on the premium collected for the renewal, assuming the underwriter has factored in all necessary risk elements into the pricing. The correct answer is B. Conduct a detailed review of the surveyor's report and the policy wording, cross-referencing with the underwriter's notes to ascertain the accuracy of the exclusion and the necessity for an endorsement, and discuss findings with the junior underwriter. Explanation. This scenario presents a professional challenge due to the inherent conflict between a supervisor's duty to ensure regulatory compliance and the potential for a team member to overlook critical details in a complex area like commercial property insurance. The supervisor must exercise careful judgment to uphold the integrity of the insurance process and protect both the insurer and the policyholder. The correct approach involves a thorough review of the policy wording against the insured's declared business operations and the surveyor's report. This ensures that the policy accurately reflects the risks being covered and that all relevant exclusions and conditions are understood and applied appropriately. Specifically, for commercial property insurance, adherence to the Insurance Act 2015 UK is paramount. This act places a duty of fair presentation on the insured and a duty of disclosure on the insurer. A supervisor's role is to ensure the insurer is meeting its obligations, which includes verifying that the policy terms align with the information provided and that any endorsements or exclusions are clearly communicated and justified based on the risk assessment. This proactive verification prevents potential disputes and ensures the policy is fit for purpose, aligning with the principles of good faith and transparency mandated by the Act. An incorrect approach would be to accept the junior underwriter's assurance without independent verification. This fails to meet the supervisor's oversight responsibilities and could lead to a policy being issued with inadequate coverage or inappropriate terms, potentially breaching the duty of fair presentation owed to the insured and exposing the insurer to unforeseen liabilities. It also neglects the supervisor's duty to mentor and ensure the competence of their team. As per the Financial Conduct Authority, FCA, Conduct of Business Sourcebook, COBS, principles regarding treating customers fairly and ensuring adequate controls. Another incorrect approach would be to immediately reject the policy and reprimand the junior underwriter without understanding the specifics of the surveyor's report or the underwriter's rationale. This demonstrates poor leadership and a lack of due diligence. It fails to identify the root cause of the potential discrepancy and does not foster a learning environment. It also risks unfairly penalizing a team member who may have made a genuine oversight rather than a deliberate error. A third incorrect approach would be to focus solely on the premium amount without scrutinizing the policy terms. While premium is important, it is secondary to ensuring the policy accurately reflects the risk and provides appropriate coverage. Overlooking the policy wording in favor of the financial aspect would be a significant regulatory failure, as it prioritizes profit over sound underwriting and customer protection, contravening FCA principles and potentially leading to mis-selling or inadequate claims handling. The professional decision-making process should involve 1. Identifying the potential issue discrepancy between surveyor's report and policy. 2. Gathering all relevant documentation, surveyor's report, policy wording, underwriter's notes. 3. Conducting a thorough, independent review of the policy against the risk assessment. 4. Engaging with the junior underwriter to understand their decision-making process and provide guidance. 5. Escalating or amending the policy as necessary to ensure full regulatory compliance and sound underwriting practice. Question 9. When evaluating a claim for a damaged antique piece of furniture, the policyholder provides an invoice for its original purchase price from 20 years ago. However, independent market research suggests the current market value of such an item, in its pre-damaged condition, is significantly higher. The policyholder insists on being compensated based on this higher current market value, arguing that this is what it would cost them to replace the item with a similar one today. As a certified insurance supervisor, which approach best upholds the principle of indemnity and regulatory expectations? Option A. Reject the claim outright, stating that the policy only covers the original cost of items. Option B. Advise the policyholder that the difference between the original purchase price and the current market value is a speculative gain and not covered by the policy. Option C. Negotiate a settlement that reflects the current market value of the antique furniture, supported by independent research, to restore the policyholder to their pre-loss financial position. Option D. Offer to settle the claim based on the original purchase price invoice, as this represents the policyholder's initial financial outlay. The correct answer is D. Offer to settle the claim based on the original purchase price invoice, as this represents the policyholder's initial financial outlay. Explanation. This scenario presents a professional challenge because it requires a supervisor to balance the insurer's obligation to indemnify the policyholder with the potential for moral hazard and the need to uphold the principle of indemnity. Supervisor must ensure that the payout is fair and proportionate to the actual loss suffered, preventing the policyholder from profiting from the loss. Careful judgment is required to distinguish between a genuine loss and an attempt to gain financially beyond the original value of the insured item. The correct approach involves meticulously verifying the policyholder's claimed loss against objective evidence and market values, adhering strictly to the principle of indemnity. This principle, fundamental to insurance contracts, dictates that the insured should be restored to the financial position they were in immediately before the loss occurred, no more and no less. This approach is ethically and regulatorily sound as it prevents unjust enrichment and maintains the integrity of the insurance contract. It aligns with the duty of utmost good faith owed by both parties and ensures the insurer's solvency by preventing overpayment. An incorrect approach that involves accepting the policyholder's valuation without independent verification fails to uphold the principle of indemnity. This could lead to the policyholder receiving more than their actual loss, which is contrary to the core purpose of insurance and could be seen as facilitating a form of gain, potentially breaching regulatory requirements concerning fair claims handling and the prevention of fraudulent claims. Another incorrect approach, that of offering a settlement significantly below the demonstrable market value of the lost item, even if it covers the policyholder's initial outlay, also violates the principle of indemnity. Goal is to restore the policyholder to their pre-loss financial position, which includes the current market value of the item, not just its original cost. This could be seen as a breach of contract and potentially unfair treatment of the policyholder, leading to regulatory scrutiny. A further incorrect approach, that of delaying the settlement indefinitely under the guise of further investigation without clear justification, can also be problematic. While due diligence is necessary, undue delay can cause significant hardship to the policyholder and may breach regulatory expectations for timely claims processing. The professional decision-making process for similar situations involves a systematic evaluation of the claim against the policy terms and the principle of indemnity. Supervisors should gather all relevant evidence, seek independent valuations where necessary, and communicate transparently with the policyholder. They must be guided by regulatory requirements for fair claims settlement and ethical considerations, ensuring that the outcome is both fair to the policyholder and financially responsible for the insurer. Question 10. Governance review demonstrates that an insurer has entered into a complex arrangement with a third-party administrator involving premium financing and risk sharing. The insurer's accounting department proposes to recognize the full premium revenue upfront, citing the contractual agreement. As a certified insurance supervisor, what is the most appropriate approach to reviewing this proposed accounting treatment under statutory accounting principles? SAP. Option A. Scrutinize the economic substance of the transaction to ensure it aligns with SAP revenue recognition criteria, focusing on the transfer of risks and rewards and any continuing involvement. Option B. Accept the upfront revenue recognition based on the contractual agreement, assuming industry custom for such arrangements is sufficient justification. Option C. Prioritize the immediate improvement of the insurer's reported financial ratios, as this is a key indicator of financial health. Option D. Rely on the third-party administrator's interpretation of the accounting treatment, as they are experts in premium financing. The correct answer is A. Scrutinize the economic substance of the transaction to ensure it aligns with SAP revenue recognition criteria, focusing on the transfer of risks and rewards and any continuing involvement. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a supervisor to interpret and apply statutory accounting principles, SAP, in a situation where the underlying business activity is complex and potentially subject to misinterpretation. The supervisor must balance the need for accurate financial reporting under SAP with the potential for aggressive accounting practices that might distort the true financial position of the insurer. The challenge lies in identifying when a transaction, though seemingly legitimate, might not align with the conservative intent of SAP. Correct approach analysis. The correct approach involves scrutinizing the substance of the transaction to ensure it meets the specific criteria for revenue recognition under SAP. This means verifying that the risks and rewards of ownership have genuinely transferred to the third party, and that the insurer has no continuing involvement or contingent liabilities that would preclude immediate recognition of the premium. This aligns with the fundamental principle of SAP to provide a conservative view of an insurer's financial strength, ensuring that assets are not overstated and liabilities are not understated. Regulatory guidance for SAP emphasizes prudence and conservatism, requiring that revenue is recognized only when earned and realized, and that contingent gains are not anticipated. Incorrect approach is analysis. An approach that focuses solely on the contractual wording of the agreement without assessing the economic substance of the transaction is incorrect. This fails to uphold the conservative nature of SAP, as it could allow for the premature recognition of revenue based on a legalistic interpretation that ignores the underlying economic reality and potential for future claims or recourse. This violates the principle of substance over form, a cornerstone of accounting and regulatory oversight. An approach that prioritizes the immediate improvement of reported financial ratios without a thorough SAP analysis is also incorrect. This demonstrates a potential conflict of interest or a lack of professional skepticism, where the desire for favorable reporting overshadows the obligation to adhere to regulatory accounting standards. This can lead to misrepresentation of the insurer's financial health, potentially misleading regulators and policyholders. An approach that relies on industry custom or the practices of other insurers without independent verification against SAP is flawed. While industry norms can provide context, they do not supersede specific regulatory accounting principles. Each insurer's transactions must be evaluated against the applicable SAP framework, and simply mirroring others' practices without due diligence is a failure of professional responsibility and regulatory compliance. Professional reasoning. Professionals should adopt a decision-making framework that begins with understanding the specific SAP requirements for the transaction in question. This involves consulting the relevant state insurance department regulations and the NAIC SAP manual. The next step is to analyze the economic substance of the transaction, looking beyond the legal documentation to the actual transfer of risks and rewards. A critical assessment of any continuing involvement or contingent liabilities is essential. If there is any doubt or ambiguity, seeking clarification from the insurer's chief financial officer, external auditors, or even the state insurance department is a prudent step. The ultimate goal is to ensure that financial reporting is both compliant with SAP and reflective of the insurer's true financial condition. Question 11. Stakeholder feedback indicates a concern regarding the timely and accurate accounting for reinsurance recoveries. A supervisor is reviewing a new reinsurance treaty where the reinsurer is an affiliate of the ceding insurer. The treaty is structured such that the reinsurer agrees to cover a portion of the ceding insurer's losses on a specific class of business. The supervisor needs to determine the appropriate accounting treatment for potential recoveries under this treaty. Which of the following approaches best reflects regulatory compliance and sound accounting practice for reinsurance? Option A. Treat all recoveries from affiliate reinsurers as an intercompany adjustment, to be recognized only when cash is physically transferred between the entities. Option B. Assess whether the reinsurance contract transfers significant insurance risk to the reinsurer, and only recognize recoveries when they are virtually certain to be received and reliably measurable, in accordance with FRS 102 and relevant FCA guidance. Option C. Recognize reinsurance recoveries as income immediately upon the occurrence of a claim covered by the treaty, assuming the affiliate reinsurer will ultimately pay. Option D. Recognize recoveries based on the gross claims reported by the cedent, without detailed verification of the reinsurer's acceptance or the specific timing of their payment obligation. The correct answer is C. Recognize reinsurance recoveries as income immediately upon the occurrence of a claim covered by the treaty, assuming the affiliate reinsurer will ultimately pay. Explanation: this scenario is professionally challenging because it requires a supervisor to navigate the complexities of reinsurance accounting while ensuring compliance with specific regulatory requirements, particularly concerning the recognition and reporting of reinsurance recoveries. The supervisor must balance the need for accurate financial reporting with the potential for misinterpretation or manipulation of reinsurance arrangements. Careful judgment is required to distinguish between genuine risk transfer and arrangements that may appear to be reinsurance, but are structured to achieve accounting benefits without commensurate risk sharing. The correct approach involves ensuring that the reinsurance contract meets the definition of reinsurance under relevant UK regulations and accounting standards, e.g., FRS 102, the financial reporting standard applicable in the UK and Republic of Ireland. This means verifying that the reinsurer assumes genuine insurance risk from the cedent. For accounting purposes, this typically requires that the reinsurer's liability depends on the uncertainty of the insured event, and that the reinsurer is exposed to a significant possibility of suffering a loss. Recoveries should only be recognized when they are virtually certain to be received and can be measured reliably. This aligns with the principle of prudence and the requirement for financial statements to present a true and fair view. An incorrect approach would be to recognize reinsurance recoveries immediately upon the occurrence of a claim, irrespective of whether the reinsurer has accepted the claim or the timing of the actual cash flow. This fails to adhere to the principle of prudence and the recognition criteria for assets and income, potentially overstating the insurer's financial position. Another incorrect approach is to treat all intercompany reinsurance arrangements as automatically qualifying for immediate recognition of recoveries, without assessing the substance of the risk transfer. This ignores the regulatory requirement to look beyond the legal form of a transaction to its economic substance. Finally, an incorrect approach would be to delay the recognition of reinsurance recoveries until the cash has been received, even if the reinsurer has accepted liability and the amount is certain. This would violate the accruals basis of accounting and misrepresent the insurer's financial performance and position. Professionals should adopt a decision-making framework that prioritizes understanding the specific terms and conditions of the reinsurance contract, assessing the economic substance of the risk transfer, and applying the relevant UK accounting standards and regulatory guidance for reinsurance accounting. This involves seeking clarification from legal and accounting experts when necessary and maintaining robust internal controls to ensure accurate and compliant reporting. Question 12. Regulatory review indicates that an insurance company is planning to introduce a suite of innovative new insurance products that leverage emerging technologies for underwriting and claims processing. While these products aim to enhance efficiency and customer experience, they also involve novel risk profiles and data handling practices. As a certified insurance supervisor, what is the most appropriate course of action to ensure compliance with regulatory requirements? Option A. Instruct the company to launch the products immediately to gain market traction, with the understanding that any regulatory concerns can be addressed retrospectively. Option B. Recommend that the company submit a comprehensive proposal detailing the new products, their operational mechanisms, risk mitigation strategies, and proposed compliance measures for explicit regulatory approval prior to launch. Option C. Advise the company to proceed with the product launch after internal risk assessments are completed and to notify the regulator of the changes post-implementation. Option D. Suggest that the company make minor adjustments to existing compliant products and market them as new offerings, as this would likely fall within acceptable operational parameters without extensive regulatory review. The correct answer is C. Advise the company to proceed with the product launch after internal risk assessments are completed and to notify the regulator of the changes post-implementation. Explanation. This scenario presents a professional challenge due to the inherent tension between a company's desire to innovate and expand its product offerings and the stringent regulatory requirements designed to protect policyholders and ensure market stability. The supervisor must balance supporting business growth with upholding compliance, requiring a nuanced understanding of the regulatory framework and its practical implications for operational changes. Careful judgment is essential to avoid both stifling innovation and compromising regulatory adherence. The correct approach involves a proactive and thorough engagement with the regulatory body. This entails not only submitting the proposed product changes for review, but also providing comprehensive documentation that clearly articulates how the new products will comply with all relevant solvency, conduct of business, and consumer protection rules. This includes demonstrating adequate risk management frameworks, appropriate pricing, clear policy terms, and effective complaint handling procedures. This approach is correct because it aligns with the fundamental principles of regulatory oversight, which prioritize policyholder protection and financial soundness. By seeking explicit approval and demonstrating compliance upfront, the supervisor ensures that the company operates within the bounds of the law and ethical standards, fostering trust with both regulators and consumers. An incorrect approach would be to proceed with the product launch without awaiting full regulatory approval, assuming that the changes are minor and will likely be accepted. This is a regulatory failure because it bypasses the established oversight mechanisms designed to prevent potential harm to consumers or the financial stability of the insurer. It demonstrates a disregard for the supervisory authority and the legal requirements governing insurance product development. Another incorrect approach would be to implement the changes and only inform the regulator after the products are already in the market, framing it as a notification rather than a request for approval. This is an ethical and regulatory failure, as it undermines the principle of prior authorization for significant product modifications. It suggests a lack of transparency and a potential attempt to circumvent scrutiny, which erodes confidence and could lead to penalties. A further incorrect approach would be to make superficial changes to existing compliant products and market them as new without undergoing the full regulatory review process for new product introductions. This is a deceptive practice and a clear violation of regulatory requirements. It misrepresents the nature of the product and avoids the necessary scrutiny that ensures consumer protection and fair market practices. The professional decision-making process for similar situations should involve a systematic evaluation of any proposed operational change against the relevant regulatory framework. This includes identifying all applicable laws, rules, and guidelines. Supervisors should then assess the potential impact of the change on policyholders, the company's financial stability, and market conduct. If the change involves new products, services, or significant modifications to existing ones, the default position should be to seek prior regulatory approval and provide all necessary supporting documentation. Open communication and a commitment to transparency with the regulator are paramount throughout the process. Question 13. The control framework reveals that an insurer has listed a significant portion of its assets on its balance sheet. As a certified insurance supervisor, what is the most appropriate action to ensure compliance with solvency requirements regarding admitted versus non-admitted assets? Option A. Broadly categorize all tangible assets as admitted and all intangible assets as non-admitted without further investigation. Option B. Verify that each asset listed is readily available to meet policyholder claims and is not subject to encumbrances that would prevent its liquidation for that purpose, in accordance with UK insurance regulations and CIS guidelines. Option C. Accept the insurer's internal classification of all listed assets as admitted, assuming they are owned by the company. Option D. Rely on the general understanding of asset admissibility, without consulting specific regulatory definitions or guidelines. Correct answer is B. Verify that each asset listed is readily available to meet policyholder claims and is not subject to encumbrances that would prevent its liquidation for that purpose, in accordance with UK insurance regulations and CIS guidelines. Explanation: this scenario presents a professional challenge because a certified insurance supervisor, CIS, must ensure that an insurer's financial statements accurately reflect its solvency position, which is directly impacted by the classification of assets. Misclassifying assets can lead to a misrepresentation of the insurer's ability to meet its obligations to policyholders, a core ethical and regulatory imperative. The supervisor must apply a rigorous decision-making framework to distinguish between admitted and non-admitted assets, adhering strictly to the regulatory guidelines applicable to the Certified Insurance Supervisor (CIS) exam, which are understood to be based on UK regulations and CIS guidelines for the purpose of this exercise. The correct approach involves meticulously reviewing the insurer's asset ledger against the specific criteria for admitted assets as defined by UK insurance regulations and CIS guidelines. This means verifying that each asset is readily available to meet policyholder claims and is not subject to encumbrances or restrictions that would prevent its liquidation for that purpose. For instance, tangible assets like property and equipment used in the normal course of business, and financial assets like cash, bonds, and shares held by the insurer are typically admitted if they meet specific valuation and liquidity requirements. The regulatory justification for this approach is rooted in the principle of solvency and the protection of policyholders. UK insurance law, as interpreted by CIS, mandates that insurers maintain sufficient admitted assets to cover their liabilities. Failure to do so can result in regulatory sanctions, including fines and restrictions on business operations. An incorrect approach would be to broadly categorize all assets owned by the insurer as admitted without due diligence. This fails to recognize that certain assets, while owned, may not be readily accessible or liquid enough to satisfy policyholder claims in a timely manner. For example, intangible assets like goodwill or unamortized acquisition costs are generally considered non-admitted because they cannot be directly liquidated to pay claims. Another incorrect approach would be to assume that any asset listed on the insurer's balance sheet is admitted. This overlooks the crucial distinction between an asset's existence and its admissibility under regulatory rules. For example, assets pledged as collateral for loans or subject to legal disputes might be considered non-admitted because their availability to policyholders is compromised. A further incorrect approach would be to rely solely on the insurer's internal classification without independent verification. This would abdicate the supervisor's responsibility to ensure regulatory compliance and could allow for deliberate or accidental misrepresentation of the insurer's financial health. The regulatory and ethical failure here is a breach of the supervisor's duty of care and oversight, potentially leading to an insurer operating with insufficient capital, thereby jeopardizing policyholder security. Professional decision-making process for similar situations should involve a systematic review of the insurer's asset portfolio, cross-referencing each asset against the definitive list and criteria for admitted assets provided by the relevant regulatory body, UK insurance regulations and CIS guidelines. This requires a thorough understanding of the definitions and exclusions, and a critical assessment of the liquidity and availability of each asset. When in doubt, supervisors should seek clarification from regulatory guidance or consult with legal and actuarial experts. Question 14. System analysis indicates that a supervisor in a UK-based insurance firm is tasked with setting performance goals for their sales team. The firm operates under the regulatory oversight of the Financial Conduct Authority, FCA, and adheres to the professional standards promoted by the Chartered Institute for Securities and Investment, CIS. The supervisor is considering several approaches to define these goals. Which of the following approaches best aligns with regulatory requirements and professional ethical standards for setting performance goals in this context? Option A. Establish performance metrics that are primarily driven by customer retention rates and the successful resolution of customer complaints, alongside adherence to all prescribed sales process documentation. Option B. Develop goals that emphasize achieving a high volume of new policy sales, with a secondary focus on ensuring basic policy details are accurately recorded. Option C. Set ambitious, yet achievable, targets for policy sales that are directly linked to the firm's profitability, with the understanding that some minor deviations from strict procedural guidelines may be necessary to meet these targets. Option D. Create performance goals that are largely qualitative, focusing on general team morale and individual effort, with minimal emphasis on specific, measurable outcomes. The correct answer is B. Develop goals that emphasize achieving a high volume of new policy sales, with a secondary focus on ensuring basic policy details are accurately recorded. Explanation. Scenario analysis. This scenario presents a common challenge for supervisors in the insurance industry, setting performance goals for their team that are both motivating and compliant with regulatory expectations. The challenge lies in balancing the need for measurable outcomes with the ethical imperative to avoid setting unrealistic or potentially harmful targets that could lead to misconduct or poor customer outcomes. A supervisor must understand the regulatory landscape, the specific roles and responsibilities of their team, and the potential impact of performance metrics on behavior. Failure to do so can result in regulatory breaches, damage to the firm's reputation, and harm to consumers. Correct approach analysis. The correct approach involves developing performance goals that are smart, specific, measurable, achievable, relevant, time-bound, and crucially aligned with the firm's regulatory obligations and ethical standards. This means goals should encourage compliant behavior, focus on quality of service and customer outcomes, and be attainable within the given resources and market conditions. For instance, goals might focus on customer satisfaction scores, adherence to claims handling procedures, or completion of compliance training, rather than solely on volume-based metrics that could incentivize rushing or cutting corners. This approach directly supports the principles of treating customers fairly and maintaining market integrity, which are core tenets of insurance regulation in the UK, as overseen by bodies like the FCA. The CIS, Chartered Institute for Securities and Investment, also emphasizes ethical conduct and professional responsibility in its qualifications, reinforcing the need for goals that promote good practice. Incorrect approaches analysis. Setting performance goals solely based on aggressive sales targets without considering the quality of sales or customer suitability is a significant regulatory and ethical failure. This can lead to mis-selling, breaches of the FCA's principles for businesses, particularly Principle 6, customers' interests, and Principle 7, communications with clients, and a disregard for the customer's best interests. Focusing exclusively on individual agent performance metrics without considering team collaboration or the impact on overall customer service can create a competitive environment that undermines collective responsibility and may lead to agents withholding information or engaging in behaviors that benefit them individually at the expense of the customer or the firm. This can contravene the spirit of fostering a positive and compliant work culture. Implementing performance goals that are vague, unmeasurable, or unattainable creates an environment of frustration and demotivation. It also makes it impossible to objectively assess performance and can lead to accusations of unfairness, potentially leading to disputes and a breakdown in trust, which is detrimental to both staff morale and regulatory oversight. Professional reasoning. A supervisor should approach goal setting by first understanding the firm's strategic objectives and the specific regulatory requirements applicable to their area of operation. They should then consult with their team to understand current workloads, challenges, and capabilities. Goals should be collaboratively developed, ensuring they are clearly defined, measurable, and directly linked to desired outcomes that are both commercially sound and ethically responsible. Regular review and feedback mechanisms are essential to adjust goals as needed and to provide support to team members. This process ensures that performance management is a tool for development and compliance, rather than a source of undue pressure or risk. Question 15. Risk assessment procedures indicate that an insurer's combined ratio has been steadily increasing over the past 3 fiscal years, while its solvency margin has been gradually decreasing. The insurer's management attributes these trends to increased competition and rising operational costs. As a certified insurance supervisor, which of the following approaches is most appropriate for further investigation? Option A. Focus solely on the current solvency margin figure to ensure it remains above the minimum regulatory threshold, as this is the primary indicator of financial stability. Option B. Request a detailed breakdown of all operational expenses to identify specific areas of cost increases, without comparing the combined ratio to industry benchmarks. Option C. Accept the insurer's explanation regarding increased competition and operational costs, and monitor the ratios for any further significant deterioration in the next reporting period. Option D. Compare the insurer's current combined ratio and solvency margin trends against a peer group of similar insurers and the insurer's own historical performance, seeking detailed explanations for any significant deviations. The correct answer is D. Compare the insurer's current combined ratio and solvency margin trends against a peer group of similar insurers and the insurer's own historical performance, seeking detailed explanations for any significant deviations. Explanation. This scenario presents a professional challenge because a supervisor must interpret financial data not just for accuracy, but for its implications regarding regulatory compliance and the financial health of the insurance entity. The supervisor's role extends beyond simple data verification to proactive risk identification and mitigation. The challenge lies in discerning whether observed ratio trends are indicative of normal business fluctuations or potential solvency issues that require immediate supervisory intervention. The correct approach involves a comparative analysis of the insurer's key financial ratios against industry benchmarks and the insurer's own historical performance. This method allows for the identification of significant deviations that might signal underlying problems. For instance, a declining liquidity ratio compared to industry averages could indicate an inability to meet short-term obligations, a direct concern for regulatory bodies focused on policyholder protection. Similarly, a consistent upward trend in a claims-to-premium ratio, when not explained by market conditions, could point to inadequate pricing or underwriting practices, both of which fall under supervisory scrutiny. This approach is justified by the regulatory framework, which mandates supervisors to monitor the financial stability of insurers to ensure they can meet their obligations to policyholders. The principle of solvency and prudent financial management is paramount, and comparative ratio analysis is a primary tool for assessing adherence to these principles. An incorrect approach would be to solely focus on the absolute values of the ratios, without considering their trends or industry context. For example, if a liquidity ratio is within the regulator's minimum threshold but has been steadily decreasing over several reporting periods, ignoring this trend would be a failure to identify a developing risk. This neglects the forward-looking aspect of supervision and could lead to a situation where the insurer's financial position deteriorates significantly before any action is taken. Another incorrect approach is to dismiss deviations from benchmarks without seeking a reasonable explanation from the insurer. This can lead to overlooking genuine issues that the insurer may be attempting to conceal or is unaware of. The regulatory expectation is for supervisors to be diligent and inquisitive, not to accept data at face value without critical evaluation. Professionals should adopt a decision-making process that begins with understanding the regulatory objectives for financial supervision. This involves identifying the key financial ratios relevant to solvency, liquidity, and profitability within the specific regulatory jurisdiction. The next step is to establish a baseline for comparison, which includes both historical data for the insurer and relevant industry benchmarks. Any significant variances identified should trigger a request for explanation from the insurer, supported by documentation. The supervisor must then critically evaluate these explanations, considering the insurer's business model and market conditions. If explanations are unsatisfactory or if risks are confirmed, the supervisor must escalate the issue according to established internal procedures, potentially leading to regulatory action. Question 16. Research into the effectiveness of interdepartmental communication regarding emerging risk indicators has revealed a significant delay in claims data being shared with the underwriting department. This delay is impacting the underwriting team's ability to adjust policy pricing and risk appetite in a timely manner. As a certified insurance supervisor, CIS, what is the most effective approach to address this breakdown in collaboration and build trust between the two departments? Option A. Recommend the implementation of a new, complex data analytics software for the claims department to automatically flag risks without addressing the underlying communication and collaboration issues. Option B. Organize a facilitated cross-departmental meeting to identify the root causes of the delay, explore process improvements, and establish clear communication protocols and service-level agreements. Option C. Report the communication breakdown to senior management as a critical failure in operational efficiency, without first attempting to mediate a solution between the departments. Option D. Issue a directive to the claims department to immediately increase the frequency of data submission to underwriting, regardless of their current capacity or existing processes. The correct answer is B. Organize a facilitated cross-departmental meeting to identify the root causes of the delay, explore process improvements, and establish clear communication protocols and service-level agreements. Explanation. Scenario analysis. This scenario presents a common challenge for a certified insurance supervisor, CIS, where differing departmental priorities and communication breakdowns can hinder effective risk management and regulatory compliance. The core challenge lies in balancing the need for timely information from the underwriting department with the operational constraints and data collection processes of the claims department. A supervisor must navigate these interdepartmental dynamics to ensure that potential risks identified by claims are adequately addressed by underwriting, thereby protecting the insurer's financial stability and policyholder interests, all within the strictures of regulatory expectations. This requires not just an understanding of operational workflows, but also a keen awareness of the ethical and regulatory imperative to maintain robust internal controls and foster a collaborative environment. Correct approach analysis. The correct approach involves initiating a structured, cross-departmental meeting facilitated by the supervisor. This meeting should aim to understand the root causes of the delay in claims data being shared with underwriting, explore potential process improvements, and establish clear communication protocols and service-level agreements. This approach is correct because it directly addresses the collaborative breakdown and seeks a sustainable solution. It aligns with the CIS's responsibility to ensure effective internal controls and risk management frameworks, as mandated by regulatory bodies overseeing the insurance industry. By fostering open dialogue and joint problem-solving, the supervisor builds trust and collaboration, which are essential for identifying and mitigating emerging risks proactively. This proactive stance is a cornerstone of sound governance and regulatory compliance, ensuring that the insurer operates with integrity and in the best interests of its policyholders. Incorrect approach is analysis. One incorrect approach is to unilaterally mandate a new reporting deadline for the claims department without consulting underwriting or understanding the claims department's capacity. This fails to acknowledge the collaborative nature of effective risk management and can lead to resentment, decreased morale, and potentially inaccurate or incomplete data being rushed to underwriting. Bypasses the opportunity to build trust and instead imposes a top-down solution that may not be practical or sustainable, potentially violating principles of good governance and operational efficiency expected by regulators. Another incorrect approach is to escalate the issue directly to senior management without attempting to resolve it at the departmental level. While escalation may eventually be necessary, bypassing the supervisory role in facilitating interdepartmental dialogue misses a critical opportunity to demonstrate leadership in building collaboration and trust. This can be perceived as an abdication of responsibility and may lead to a perception of a lack of problem-solving capability, which is contrary to the expectations of a CIS. Regulators expect supervisors to actively manage and resolve operational issues that could impact compliance and risk. A third incorrect approach is to focus solely on the technical aspects of data transfer, such as IT solutions, without addressing the underlying communication and collaboration issues. While technology can be a facilitator, it cannot replace the need for clear communication channels, mutual understanding of departmental needs, and a shared commitment to risk management objectives. This approach neglects the human element of collaboration, which is crucial for building lasting trust and ensuring that processes are not just technically sound, but also operationally effective and ethically driven. Professional reasoning. When faced with interdepartmental friction impacting operational efficiency and risk management, a CIS should first seek to understand the perspectives of all involved parties. This involves active listening and a commitment to facilitating dialogue. The professional decision-making process should then focus on identifying the root causes of the issue, which often lie in communication gaps or misaligned priorities. The supervisor should then propose solutions that are collaborative, sustainable, and aligned with regulatory expectations for good governance and risk management. This involves seeking consensus, establishing clear expectations, and fostering an environment where departments feel empowered to work together towards common goals, thereby building trust and enhancing overall organizational resilience. Question 17. To address the challenge of effectively monitoring compliance with insurance laws and regulations, a certified insurance supervisor is developing a risk assessment framework. Which of the following approaches would best enable the supervisor to proactively identify potential areas of noncompliance? Option A. Implementing a compliance monitoring program that is triggered only after a significant customer complaint has been received. Option B. Prioritizing monitoring efforts based on the volume of transactions in each business unit, regardless of the inherent regulatory complexity. Option C. Analyzing regulatory changes, internal audit reports, customer complaints, and market developments to identify potential compliance vulnerabilities. Option D. Focusing exclusively on past enforcement actions and fines levied against other insurance firms in the jurisdiction. The correct answer is C. Analyzing regulatory changes, internal audit reports, customer complaints, and market developments to identify potential compliance vulnerabilities. Explanation. This scenario is professionally challenging because a supervisor must balance the need for proactive risk identification with the practical limitations of resources and the potential for overregulation. The supervisor's role is to ensure the firm operates within the bounds of the law and regulatory requirements, but this must be done efficiently and effectively. The challenge lies in developing a risk assessment approach that is comprehensive enough to identify potential compliance breaches without becoming overly burdensome or speculative. Careful judgment is required to prioritize areas of greatest risk and allocate supervisory attention accordingly. The correct approach involves a systematic and data-driven method for identifying potential compliance risks. This means analyzing various sources of information, such as regulatory changes, internal audit findings, customer complaints, and market trends, to pinpoint areas where the firm might be vulnerable to noncompliance. By focusing on these identified risks, the supervisor can then develop targeted monitoring strategies, allocate resources efficiently, and implement preventative measures. This aligns with the principles of good governance and regulatory oversight, ensuring that the firm's compliance framework is robust and responsive to evolving risks. The regulatory framework for insurance supervisors emphasizes a risk-based approach to supervision, which necessitates identifying and assessing risks to inform supervisory actions. An approach that relies solely on historical data without considering emerging trends or new regulatory pronouncements would be a failure. This is because it would likely miss new or evolving compliance risks, leaving the firm exposed. Similarly, an approach that focuses only on high-profile or frequently cited regulatory breaches might overlook less common but equally serious compliance issues that could arise from specific business activities or new product launches. A purely reactive approach, waiting for breaches to occur before investigating, is fundamentally flawed as it fails to fulfill the supervisory duty of proactive oversight and risk mitigation. This reactive stance is contrary to the preventative and prudential nature of effective regulatory supervision. Professionals should employ a decision-making framework that begins with understanding the current regulatory landscape and the firm's specific business operations. This understanding should then inform the development of a risk assessment methodology that is both comprehensive and practical. The process should involve continuous learning and adaptation, incorporating feedback from internal and external sources. When evaluating potential compliance risks, supervisors should ask, what could go wrong? How likely is it? And what would be the impact? This structured thinking, combined with a thorough understanding of regulatory expectations, allows for the prioritization of supervisory efforts and the development of effective compliance monitoring programs. Question 18. Analysis of an applicant's medical history reveals a pre-existing condition that, according to the insurer's underwriting guidelines, typically increases the likelihood of future claims. As a certified insurance supervisor, what is the most appropriate course of action to ensure compliance with regulatory requirements and ethical obligations regarding risk selection and classification? Option A. Approve the applicant for coverage at standard rates without further investigation, assuming the condition is well managed and poses no significant additional risk. Option B. Immediately decline coverage for the applicant due to the presence of the pre-existing condition, as it represents an increased risk. Option C. Conduct a detailed review of the applicant's medical history against the specific underwriting criteria for that condition, considering any mitigating factors or evidence of effective management to determine the appropriate risk classification or terms. Option D. Advise the applicant that due to their medical history, they are ineligible for insurance and suggest they seek alternative coverage options. The correct answer is C. Conduct a detailed review of the applicant's medical history against the specific underwriting criteria for that condition, considering any mitigating factors or evidence of effective management to determine the appropriate risk classification or terms. Explanation. This scenario is professionally challenging because it requires a supervisor to balance the insurer's need for accurate risk assessment with the ethical obligation to treat all applicants fairly and without undue discrimination. The supervisor must ensure that risk selection and classification processes are not only compliant with regulatory requirements, but also uphold principles of fairness and prevent adverse selection without resorting to discriminatory practices. Careful judgment is required to interpret and apply the relevant regulatory framework to a specific applicant's situation. Correct approach involves a thorough and objective assessment of the applicant's risk profile based on established underwriting guidelines and relevant legislation. This means gathering all necessary information, evaluating it against defined risk factors, and classifying the applicant accordingly. This approach is correct because it adheres to the principles of sound underwriting, which are designed to ensure the financial stability of the insurer by accurately pricing risk. Furthermore, it aligns with regulatory expectations that insurers operate transparently and apply their underwriting criteria consistently and fairly, avoiding arbitrary decisions. The regulatory framework for insurance supervisors emphasizes the importance of robust risk management and fair treatment of customers, both of which are served by this objective assessment. An incorrect approach would be to reject the applicant solely based on a perceived, unsubstantiated increase in risk, without a clear, documented basis in the underwriting guidelines or relevant legislation. This fails to demonstrate a systematic and objective evaluation of the applicant's specific circumstances and could lead to unfair discrimination. Another incorrect approach would be to approve the applicant without proper consideration of the identified risk factors, potentially exposing the insurer to undue financial loss and undermining the integrity of the underwriting process. This neglects the supervisor's duty to ensure the insurer's financial soundness and compliance with risk management principles. A third incorrect approach would be to apply a blanket policy that automatically categorizes all individuals with a particular characteristic into a high-risk group without individual assessment, which is likely to be discriminatory and violate principles of fair treatment and potentially specific anti-discrimination laws. Professionals should employ a decision-making framework that begins with understanding the specific regulatory requirements governing risk selection and classification. This involves consulting the insurer's own underwriting manual and relevant legislation. The next step is to gather all pertinent information about the applicant objectively. This information should then be systematically evaluated against the established criteria. If the evaluation indicates a potential for increased risk, the supervisor must determine if this is a justifiable basis for classification or refusal according to the regulations. Documentation of the entire process, including the rationale for the final decision, is crucial for accountability and future review. Question 19. The investigation demonstrates that a certified insurance supervisor is reviewing an employee's annual performance appraisal. The supervisor has a generally positive personal relationship with the employee and feels they are a good fit for the team, but has not recently reviewed specific project outcomes or objective performance metrics. The supervisor is considering completing the appraisal based on this overall positive feeling and the employee's length of service, rather than a detailed analysis of their achievements against set targets. Which approach to completing the performance appraisal is most consistent with regulatory requirements and professional best practice for a certified insurance supervisor? Option A. Base the appraisal primarily on the supervisor's general positive impression of the employee's attitude and perceived effort, as this reflects their overall contribution to team morale. Option B. Defer the completion of the appraisal to a more senior manager, providing only a brief summary of the supervisor's overall positive sentiment towards the employee. Option C. Conduct a detailed review of the employee's documented performance against predefined objectives and key performance indicators, ensuring the appraisal is evidence-based and objective. Option D. Prioritize the employee's tenure and loyalty to the company when completing the appraisal, as these qualities are valuable assets to the organization. Correct answer is C. Conduct a detailed review of the employee's documented performance against predefined objectives and key performance indicators, ensuring the appraisal is evidence-based and objective. Explanation: this scenario is professionally challenging because it requires a supervisor to balance the need for objective performance evaluation with the potential for bias and the regulatory imperative to ensure fair and consistent appraisal processes. The supervisor must navigate the complexities of human perception and the potential for personal relationships to influence professional judgment, all while adhering to the principles of good governance and regulatory compliance expected of a certified insurance supervisor. The core challenge lies in ensuring that performance appraisals are based on demonstrable evidence and objective criteria, rather than subjective feelings or external pressures. The correct approach involves conducting a thorough review of the employee's documented performance against predefined objectives and key performance indicators. This approach is right because it aligns with the principles of fairness, objectivity, and accountability mandated by regulatory frameworks governing employee performance management. Specifically, it upholds the expectation that appraisals should be evidence-based, transparent, and free from undue influence, thereby ensuring that employees are evaluated on their actual contributions and development needs. This systematic review process minimizes the risk of bias and promotes consistency across appraisals, which is crucial for employee morale, development, and compliance with employment law and internal HR policies. An incorrect approach that relies solely on the supervisor's general impression of the employee's attitude and perceived effort fails to meet regulatory and ethical standards. This approach is problematic because it is inherently subjective and lacks concrete evidence. It opens the door to unconscious bias and can lead to unfair evaluations, potentially resulting in discrimination claims or breaches of employment regulations that require objective performance assessment. Another incorrect approach that involves prioritizing the employee's tenure and loyalty over specific performance metrics is also professionally unacceptable. While loyalty and experience are valuable, performance appraisals are fundamentally about assessing an individual's effectiveness in their role against established standards. Basing an appraisal primarily on tenure or loyalty disregards the core purpose of performance management, which is to identify strengths, areas for development, and ensure that performance aligns with organizational goals. This can lead to a lack of accountability for underperformance and a failure to recognize high achievers, creating an inequitable work environment and potentially violating regulations that mandate performance-based evaluations. A further incorrect approach that involves deferring the appraisal to a more senior manager without providing a comprehensive, evidence-based assessment is also flawed. While seeking guidance can be appropriate, abdicating the responsibility for a well-reasoned, documented appraisal without contributing substantive, objective input is a failure of supervisory duty. It suggests an unwillingness or inability to perform a critical management function and can lead to inconsistent or uninformed evaluations, undermining the integrity of the performance management system and potentially violating supervisory responsibilities outlined in regulatory guidelines. The professional decision-making process for similar situations should involve a structured approach. First, clearly understanding the objectives and criteria for performance appraisal as defined by the organization and relevant regulations. Second, gathering objective evidence of performance, including documented achievements, feedback from relevant stakeholders, and progress against set goals. Third, conducting a fair and unbiased assessment based on this evidence, ensuring consistency with how other employees are appraised. Finally, documenting the appraisal thoroughly and transparently, providing clear rationale for all assessments and developmental recommendations. This systematic process ensures that appraisals are robust, defensible, and contribute positively to both employee development and organizational effectiveness. Question 20. During the evaluation of new insurance software systems to streamline client onboarding and policy management, a supervisor is presented with two options. Option A, which is significantly cheaper and promises faster implementation, but has limited documentation regarding its data security protocols and compliance with UK financial regulations. And option B, which is more expensive and requires a longer implementation period, but provides comprehensive documentation on its adherence to FCA guidelines and GDPR. The vendor for option A has provided a general statement about their commitment to data security. Which approach should the supervisor prioritize in their recommendation? Option A. Recommend option A, arguing that the cost savings can be reinvested into future compliance upgrades once the system is operational. Option B. Recommend option A, prioritizing the immediate cost savings and faster implementation to improve operational efficiency, assuming the vendor's general statement on data security is sufficient. Option C. Recommend a hybrid approach, selecting option A for its speed and cost, and then commissioning a separate, independent audit of its security features post-implementation. Option D. Recommend option B, prioritizing comprehensive regulatory compliance and data security documentation over immediate cost savings and implementation speed. Correct answer is D. Recommend option B, prioritizing comprehensive regulatory compliance and data security documentation over immediate cost savings and implementation speed. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for operational efficiency with the long-term ethical and regulatory obligations concerning data integrity and client confidentiality. A supervisor must exercise careful judgment to ensure that the chosen software solution not only meets business objectives, but also adheres to the stringent standards expected within the insurance industry, particularly concerning the handling of sensitive client information. The pressure to implement a system quickly can create a temptation to overlook potential risks or compromise on essential security and compliance features. The correct approach involves prioritizing a thorough due diligence process that explicitly assesses the software's compliance with relevant UK regulations, such as the Financial Conduct Authority (FCA) Handbook and the General Data Protection Regulation (GDPR) as implemented in the UK. This includes verifying the software's data security protocols, audit trails, and its ability to support regulatory reporting requirements. By insisting on a comprehensive review that confirms adherence to these standards before final selection, the supervisor upholds their fiduciary duty to the firm and its clients, ensuring that client data is protected and that the firm operates within legal and ethical boundaries. This proactive stance mitigates the risk of future regulatory breaches, financial penalties, and reputational damage. An incorrect approach would be to proceed with the software that offers the most attractive cost savings without a rigorous compliance check. This fails to acknowledge the paramount importance of regulatory adherence and data protection. Such an action could lead to significant breaches of data privacy laws, resulting in substantial fines under GDPR and potential enforcement actions by the FCA. Another incorrect approach is to rely solely on the vendor's assurances regarding compliance without independent verification. While vendor statements are a starting point, a supervisor has a professional responsibility to conduct their own due diligence to ensure the claims are substantiated and that the software's functionalities truly meet the required standards. This oversight could expose the firm to risks if the vendor's claims are inaccurate or if the software has hidden vulnerabilities. Lastly, prioritizing speed of implementation over thoroughness, even with a general understanding of compliance needs, is a failure. This haste can lead to the adoption of a system that, while functional, may have critical security flaws or reporting deficiencies that only become apparent after implementation, causing significant disruption and potential regulatory issues. Professionals should adopt a structured decision-making framework that begins with clearly defining the regulatory and ethical requirements for any new system. This should be followed by a comprehensive evaluation of potential solutions against these requirements, including technical capabilities, security features, vendor reputation, and cost. Independent verification of compliance claims and a thorough risk assessment are crucial steps. When faced with competing priorities, such as cost versus compliance, the regulatory and ethical obligations must always take precedence. A robust internal policy for vendor selection and system implementation, incorporating sign-offs from compliance and legal departments, can provide a strong framework for making sound, defensible decisions.